We're just seeing a lot of people entering the meeting, so we'll just pause and delay the hellos for a second. All right, let's get underway. All right, good morning. Welcome to our webinar on non-dom and the tax changes that have been proposed. No surprise, this has been given a huge response by the community that we're connected into through the Australian UK Chamber of Commerce. Just by way of introduction, my name is Richard Basil-Jones. I'm the CEO for the Chamber. And for those that don't know who we are, essentially a not-for-profit organisation that has Australia, UK companies with interests in both those markets as our members. And therefore, no surprise, a lot of the people on this call will have a vested interest. The Chamber hosts lots of types of events, from geopolitical activities around AUKUS defence or around broad sector issues like the Free Trade Agreement, but we also focus in on issues that impact individuals amongst our member companies. This item is one such topic. Just by way of background, the Conservative Party announced the change to the non-dom rules in the spring budget on March 6. That is, they're looking to scrap the system that allows people to declare themselves non-domiciled in the UK for tax purposes. Now, this is a proposed change. It's not law, it's a proposed change. But be aware that these plans were something that the Labor Party were proposing as well. There's been various accusations that the Conservative Party has stolen their policy. But I think what is fairly realistic to assume is that these proposed changes are likely to come into being at some stage in the future. Election to be held by the end of January 2025, people suggesting sometime in autumn. And if you look at the polls, it's pretty clear that Labor are well out in front and likely to form government. But I think it's safe to say that these proposed changes are likely to happen, but I think what is important to say is that we don't know when, and we don't know exactly in what form or the details around it. And that's the part that's pretty challenging in this discussion. I'm about to introduce you to a couple of specialists in this area, and their role is not to provide all the answers because they don't have all the answers. What they do have is specialist knowledge in this field, and to provide some clarity about what is already being proposed, just some clarity around those types of areas. So without further ado, I'm going to introduce you to Andy Gibbs from TaxAssist Accountants. Quick bio, Andy is a Director of Services at TaxAssist Accountants, qualified Chartered Tax Advisor, and has dealt with tax compliance and tax advisory projects across a range of industry sectors, and highly qualified for this discussion. Our other speaker is Naomi Smith, who is Tax Consulting Partner at Nexia Canberra. Naomi has 22 years of diverse tax experience gained at major accounting firms in Australia and the UK, and she is an expert on cross-border tax issues. And she's currently an Australian UK Chartered Tax Advisor and a member of the UK Chartered Institute of Taxation's Technical Committee. We have two specialists. We're going to have about 25-30 minutes of content through slides, and then we're going to allow plenty of time for questions at the end. And those questions, some have been submitted in advance, which has been fantastic. Thank you. And we'll have a spot at the top of your screen. You will see something that says Q&A. If you have questions as we progress through this presentation, please submit your questions via the Q&A button, and we'll refer to those as we go. So, look, without further ado, I'm going to pass you over to Andy Gibbs.
Thanks very much, Richard. I'll just bring up my slides. So I'll crack on because thanks to the great introduction, I don't think I need to introduce me and Naomi any further, but it will be me and Naomi that will be presenting this to you. I think just to echo what Richard was saying, really, is that this is at the moment proposed legislation. You have to understand that, you know, we can comment on it, but at this stage, nothing is really firm. It's shifting sands, but we want to cover what we believe the main points are, and we do recommend that certain people will need some specialist advice, particularly in relation to trusts and IHT. So if you do after watching this need specific advice, we recommend you speak to your accountant before taking any action. And even if you speak to your accountant, you might not want to incur fees at the moment, because this is just proposed and there'll be potentially a lot of changes to this. So what we'll cover today is we're going to cover the proposed new rules, the 4-year rule for foreign income and gains. We're going to talk about some of the proposed relaxations on the regime, and particularly the temporary repatriation facility, which may be relevant to some people on this call. We're going to briefly cover trusts and IHT. We're also going to look at some of the tax traps, some of the things that, if the current proposed rules come in, to be aware of, and also some of the opportunities. There'll be a wide range of people that will be interested in this topic, Australians and New Zealanders as well, coming here, other non-doms temporarily, and perhaps people who are much here for longer periods, and different clients, different people will be in different situations in terms of how these rules will impact them. So as Richard said, the background to all of this is that the Chancellor announced, we probably did expect it, some change to the non-dom regime, but perhaps not as wholesale as what the actual change was. Changes are significant for all non-doms, their business and family wealth structures, so it's quite significant changes. There's significant uncertainty still remaining, particularly even in terms of the proposal of the IHT and the trust changes are still very uncertain, with a lot of questions that need to be answered. And as Richard said, the current government may not be in government when these rules are purported to come in. So just before we go any further, I think it's just important to understand that this is quite a kind of specialist area, and some of the concepts that are used in this area are quite not easy to always understand. One of the things that we talk about here is domicile. Domicile is quite a UK concept, which really in many ways looks at where you belong, as opposed to residence, which is really where you are. So typically Australians born in Australia to Australian parents will have what we call a domicile of origin, which I suspect a lot of people on this call may be in that circumstance. It's quite difficult to shift the domicile of origin, but it itself is quite a specialist area, so doubts on domicile are something that you would need to discuss. But on the basis somebody is non-UK domiciled, the current rules are pretty generous. Domiciled residents in the UK have a couple of choices as to how they're taxed. Very broadly, they can be taxed on what's called a rising basis, which is pretty much exactly what it says on the tin. You're taxed on your income and gains as they arise all over the world. Or alternatively, you can, in certain instances, elect to be taxed on what's known as the remittance basis, which again basically means you're taxed only on your UK income and gains, and offshore income and gains, to the extent that they're kept offshore, are not subject to UK tax. That's why they call it the remittance. When you remit, you bring stuff to the UK, that's when you get taxed. So that's the current rules. And you can switch between a rising worldwide or remittance from year to year, dependent on circumstances. The decision as to which to opt for is unique to an individual. There's no one size fits all. The regime is very complicated, but you would need to look at the levels of offshore income, the levels of UK income, and the tax that you pay on that offshore income. And it also, there are more penalties to pay the longer you've been resident in the UK. So even the current rules take a little bit of getting your head round. So I suspect a lot of people on these calls are quite used to having calls with their advisors talking about these rules, because it's probably part of an annual check that you're doing to check which basis is right for you. But the main point is the current regime is fairly generous to people coming to the UK. Subject to time limits, it means that if they come to the UK and they generate lots of offshore income and gains, provided they can keep that offshore, then potentially they can completely avoid a charge to UK tax. At the budget, the Chancellor announced a change to that regime, and they're going to bring in, from the 6th of April 2025, a new 4-year residence rule to replace the current remittance basis rules. It will be available to individuals for their first 4 tax years of UK residence, but they have to have completed at least 10 years of being non-UK resident. Where you're taxed under this new regime, you'll be fully exempt from UK tax on foreign income and gains, even if they're remitted to the UK in that first 4-year period. So that's quite a significant and change, and we'll come on to the opportunities that could come for certain individuals a bit later. If you arrived in the UK before 6th of April 2025, you can still potentially benefit from this regime, but you must be within the first 4 tax years of residence, UK residence. So we'll come on to an example straight away about how that actually looks and what that actually means. You must also have met the 10 years of non-UK residence occupation. So there's a couple of things to meet there. So if we go to a real life example of that new 4-year rule, if we imagine an individual, Sam, and Sam's moved to the UK after 25 years of living in Australia, presumably Australian born. Sam is Australian domiciled and has Australian assets. They have an investment property over in Australia. From 23-24, Sam is UK resident because they're based in London, and Sam's working in London, so she's UK resident. And they plan to sell their investment property, and they're planning in 25-26. That's when they're thinking of selling it. So in terms of timeline for Sam, for 23-24, when she came to the UK, and 24-25, she's UK resident, non-domiciled. She could choose to use the remittance basis or be arising, dependent on her circumstances. But significantly, in 25-26, Sam can claim exemption from the UK tax on foreign income and gains, which includes the sale of that investment property. So it's outside of the net of UK tax. 26-27 will be the last of Sam's 4 years, so the last that she can take advantage of that regime. And from 27-28, Sam will be subject to tax on worldwide income and gains for as long as they're in the UK. So that's a sort of brief example of what this regime looks like. To give an Australian tax perspective, I'm not sure if we've got Naomi.
Yes, I'm here. Hi, everybody. So I'll just run through some of the Australian tax implications on the transaction. So you might think in Australia there's a capital gains tax exit charge when an individual ceases to be Australian tax resident. But it's important to note that that won't apply to the rental property in this example with Sam, because that property is what they call taxable Australian real property, so it doesn't apply to taxable Australian real property. If Sam had some other assets, let's say she had some shares listed on the Australian Stock Exchange and there wasn't an underlying property element to those shares, so let's say there were some shares in one of the major banks, probably unlikely to have underlying property assets attached to it, and in which case, yes, they would have been subject to this CGT event I1, which is basically a deemed disposal at market value on the day that Sam ceased to be Australian tax resident. Or you can choose to defer those capital gains, and that can be quite an interesting option, particularly with reference to the UK-Australian double tax agreement. Sometimes it is possible to defer and then just pay UK capital gains tax on the transaction. So there's some of the things that might want to be aware of. For Sam in this particular instance, she could try and argue she's still Australian tax resident for up to 2 years under the domestic Australian tax law. Although I tend to find that you've also got to think about the double tax agreement. If she's also going to be a UK tax resident, it may be that tiebreaker clause rules in favour of the UK being her tax residency, country of tax residence for the double tax agreement. So that's another thing to watch out for. You can only sort of argue that 2-year rule if you don't know what you're going to do and you're not coming to the UK indefinitely. You're coming for sort of less than 2 years. If you know you're coming for 3 years, for instance, then you're going to be non-Australian tax resident from the outset if you don't maintain a home in Australia. Some clients do get around this by having multiple homes, and then they're the more complicated residency issues that we get. The 50% capital gains tax discounts only available during periods of residence, but it is a pro rata thing. So we've sort of not had time to write a book on these slides about that, but it is a pro rata thing. So you can get partial 50% capital gains tax discount even when you're non-resident, but it doesn't accrue during periods of non-residence. And there is no main residence exemption for persons who aren't Australian tax resident. So that can be very, very nasty. If this property had been Sam's main residence until she moved to the UK, then she can get no, she would end up with no main residence exemption if she goes to sell while she's not Australian tax resident. So she might want to think about moving back to Australia, etc. So then we've got, next slide's just got a summary there of some of the things to need to think about if a person's Australian tax resident and they're assessed a tax on their worldwide income. And if that's assuming that there's a temporary resident rule in Australia. So if you are British and you're planning on going out to Australia, then it's just worthwhile thinking that you might be able to, let's say you're going out to Australia on a skilled worker visa, you might be able to utilise the temporary resident rules to only pay tax on your Australian source income and your earned income. So it's sort of a little bit like the non-domiciled rules for the Australian tax system, but not quite. But if you're familiar with those rules in the UK, then you might be able to take advantage of them in reverse. Australian tax residents get a tax-free threshold. They are liable to Medicare levy in most cases, unless you're on a special visa, which means you can't access the Medicare system. They're taxed directly on trust distributions to them, and there are obviously no Australian withholding taxes. Non-residents, it's worthwhile just being aware that non-residents don't get a tax-free threshold, and their starting tax rate in Australia is 32.5%. They do pay withholding taxes on some kinds of sources of income like dividends and bank interest, although if the dividends are fully franked, then they won't pay tax on those in Australia. So that sort of gives you a little bit of a flavour of how the Australian tax system works depending on your tax residency status. Okay, back over to you, Andy.
Thanks, Naomi. So obviously there's been, I think as Richard touched on earlier, a lot of unsettling here, not just for Australians, but non-doms in general. And for as long as I've been in tax, whenever the remittance basis is looked at, people have always said, well, I would leave the UK if this happened. And we're certainly seeing quite a few calls from some people. But you know, there is a degree of uncertainty, and any government is not going to want to lose really important key talent for the UK. So even with the proposed legislative changes, there was a number of transitional rules to try and soften things. We'll come back to what Labour think about those later, but there are some important things to just be aware of as well, which are included in these rules. And we'll look at the temporary repatriation facility and how that can actually benefit some families and individuals as well. So to prevent this potential mass exodus, there is the first 4-year rules, which we've already covered. For 25-26 only, the proposal is that resident non-domiciled individuals in the UK who will no longer be able to claim under the new regime, maybe because they're not within their first 4 years and they're outside of that, they'll be only subject to UK tax on 50% of their foreign income, provided they're not yet deemed domiciled as at 5th of April 2025. So if you're in that situation, it's definitely something that you would speak to with your advisor to check your deemed domicile status, which is, you know, your residence in the UK based on that, because that potentially, you know, could soften the blow in that 1 year, but it is only a temporary change. There is also the promise of a rebasing of foreign assets to 5th of April 2019 for UK CGT purposes, but in order to benefit from that, you can't be deemed UK domiciled as at 5th of April 2025, and you must have previously claimed the remittance basis. There's a bit of uncertainty here. We expect there to be some further uncertainties, but for individuals that think they may be impacted about this, it might be an idea to start thinking about what their assets at 5th of April 2019 worldwide are, if they're thinking about that rebasing, because for certain assets it's pretty easy to get a rebasing. If it's shares or something on a stock market, it's very easy. We can just go back in time and we can check that. If it's a business, if it's land, if it's property, much more difficult, could be expensive to get a valuation. So certainly worth something, even if it's a rough you know, back of a fag packet sort of idea of the assets, then that still will do for now in terms of some rough planning. As well as those items, there is also talk of a temporary repatriation facility, and this new temporary repatriation facility will apply a 12% tax rate in the UK on certain remittances. Under the current regime, remittances are taxed at up to 45% UK income tax rates, but under this facility, the tax rate will be 12%. So that's potentially a good advantage. We'll come on to an example of that. This facility, it only applies to individuals who've historically claimed the remittance basis prior to 6th of April 25, and it allows them to remit income and gains between 6th of April 25 and 5th of April 27, and just be subject to a flat 12% UK tax rate. So if it's implemented, and there may be changes to this, and other governments may be in power, as we've said, but if it's implemented, it will be a crucial one-off opportunity, so a key planning point, because otherwise, from 6th of April 2027, remittances of overseas income and gains will be taxed at prevailing rates. So we will come on to an example of how that works and the potential savings, but we're just going to briefly cover trusts. I'm going to very briefly cover it from the UK tax perspective. Naomi's going to bring some expertise onto the Australian side as well. But there are some significant proposed changes to trusts. And I think with trustees, beneficiaries and settlers, if you do have offshore structures, even without these rules in place, to be fair, we have had some questions about people moving between jurisdictions. You need to get advice before you do that, even currently. But certainly these new rules will add another layer of complexity. Trusts and IHT are intrinsically linked as taxes go, and IHT is going to be subject to a consultation, which we'll come on to, and that will almost certainly impact the position of the trusts as well. So the proposal is that foreign income and gains generated within offshore trusts will be taxable on the settler, where the trust is settler interested, from 6th of April 2025. That's a very significant change from the current rules. And for pre-2025 foreign income and gains, beneficiaries of existing protected trusts will continue to be subject to UK tax on distributions. So Naomi will cover this a little bit further, but trusts are very complicated, and we would always recommend getting specialist advice here.
You go. So trusts, yeah, I think before I get into the slide, it's probably just worthwhile reiterating what Andy said. If you have a trust, whether it's an Australian trust or a UK trust, and you're planning on moving between Australia and the UK, definitely you need to see a tax advisor before you make that move, not after you make the move. You can create all sorts of tax problems, and people like myself and Andy have the fun job of sorting it out after it's after people have often made the move, and that's often after people have accidentally crystallized tax liabilities for themselves. So if you take nothing more away from this today, please do see a tax advisor before you make an international move, particularly if you've got a trust. Also, if you've got a company, you do need to get some help. And the tax advisor can't necessarily fix it after the event, or at least your options are a lot more narrow after you've made an international move. So it's just worthwhile being aware. There's the Australian tax legislation. There's a very important word in that sentence below, which talks about the definition of when a trust is Australian tax resident. And it's the word a. And you would think, why is this such an important word? But it says a trustee of the trust estate, which is basically the trust, was resident at any time during the year of income under the Australian law. That will make the trust tax resident in Australia. So let's say if you are from the UK and maybe your parents, for example, or your grandparents did some inheritance tax planning, and over the years you've become the responsible individual who's a trustee of that trust. Guess what? That UK trust can become UK tax resident, Australian tax resident, as well as it may remain UK tax resident, and then suddenly we get a dual tax resident trust, which is very messy now that the double tax agreements have been changed between the UK and Australia. There were some updates done back in 2019, well, with effects came into effect from 2019, which basically meant that we now need to write to HMRC and the ATO. It's basically a joint submission under something called the multilateral instrument, to get them to agree which country should have the taxing rights over your dual tax resident trust. And a lot of people say to me, well, how did my tax affairs ever get so complicated? And my answer to that question is, well, you set up a trust and then somebody moved countries. It's basically all it takes for your tax affairs to get very complicated if you have a trust. So do reach out to us. The other point is central management and control of the trust. If that's in Australia, that's slightly harder to prove, but you do have to watch if there's perhaps you are going to try and make the argument that a UK trust has remained UK tax resident. You just have to watch out that perhaps as the younger family members start running the trust more from Australia, that you're not necessarily even going to get the sign off that the trust has remained UK tax resident under the double tax agreement if you've got the trust being primarily run from Australia. So there's sort of some of the things to think about on this particular topic. We could probably talk about this all day, but we'll just for the sake of trying to stay to schedule, we just might move on to the next slide. So you need to watch out for any person that's got anything to do with a trust before moving to Australia or before moving from Australia to the UK. And so you need to identify the beneficiaries of the trust. So if one of the beneficiaries is, let's say it's a UK tax resident trust, and the person's going to move to Australia, it may become prohibitively expensive for that beneficiary to ever receive any money from the trust because of taxation in Australia under a anti-avoidance section number called section 99B and its sister section number 99C, which basically captures all loans that get made out of the trust. I do sometimes get people say to me, oh, well, I'll just loan the money out. And I'm like, yeah, but it's still 100% taxable in Australia when you do that. There is one little get out that's we can sometimes use to do with the corpus of the trust being not taxable on the way out. But it is a very restrictive definition of corpus, which is basically saying, well, unless it's come out, the distribution has come out of the money that's gone in, it can be very, very expensive to get the money out. There is also another evil section number, I'm going to call it section 102 AM. It doesn't apply to a UK trust, but it does apply to our trusts from most other countries on the planet. So Australia basically has 7 countries that it decides charge enough tax, which are the UK, the US, Germany, France, Japan, New Zealand, Canada. So apart from those countries, so let's say we've got a trust established in the Channel Islands, which is very common planning for non-domiciled persons. So if you sort of speaking to a lot of tax advisors and lawyers and things across the UK, they often recommend a trust in the Channel Islands, for instance, or the Isle of Man for a non-domiciled person. And that would generally be good advice. But if you plan to return to Australia, it's not such good advice, because this horrible Section 102 AM basically imputes an interest charge whenever you go to access the money out of the trust, which the combined tax under Section 99B there and Section 102 AM can be up to 100% of the money coming out of the trust, which basically means you get nothing and the Australian Tax Office gets everything. So I guess the point of this little discussion is to hopefully, if you have a trust or you're thinking about setting one up, doesn't mean you shouldn't do one, but just you need to get some specialist tax advice before you do that. If you do already have an Australian trust, there's a lot of pitfalls. There's a capital gains tax charge when a trust ceases to be tax resident in the UK, and there's also a capital gains tax charge when a trust ceases to be tax resident in Australia. And both countries basically look at the market value of the assets and whatever the cost is to the trust, and whatever that computes to being as a gain, the difference between those two numbers will be the taxable amount. There is no deferral of it either under UK law or Australian law, so it's a nasty little pitfall, which is why we were saying earlier, just watch out. You don't want your trust to be accidentally changing tax residency. And the other thing is that foreign trust doesn't get a capital gains tax discount. That's also something to be aware of. And you have to really, you can make your tax position a lot worse, which is what happened in the Greensill case. There's a person who was living outside Australia, and that person had an Australian tax resident trust and actually ended up paying a whole pile of tax on a capital gain that wouldn't have otherwise been taxable if they'd actually owned the asset directly. So I guess the moral of the story is just to make sure you've got the right advice before you do anything in relation to trusts, or if you've already got a trust, before you do any moving around the globe. I'll let Andy go talk about inheritance tax.
Thanks, Naomi. Less of an evil topic, but still up there, I think, inheritance tax. So inheritance tax, the announcement was that inheritance tax would be subject to a consultation. So again, we're talking now about proposed legislation, a consultation. So again, shaky ground in terms of giving firm advice. But in terms of what do we know in terms of what we think the new regime could look like? Because again, it's another fundamental change and a move away from domicile, which is important because there seems to have been a long-term shift away from looking at domicile as an important aspect of UK tax. Inheritance tax has always been driven by this idea of domicile, where you belong, where you come from, as opposed to where you actually are, which is more residence. From what we can see, as you would expect, in terms of inheritance tax, UK assets are likely to remain subject to UK IHT, which is what we would fully expect. For overseas assets, the change will be that IHT will depend purely on the residence and not the domicile of the individual. So that's a really significant change. And what they're talking about is after 10 years of UK residence, worldwide assets will come under UK IHT and remain so for the first 10 years of non-UK residence. So that's quite a fundamental change. It will make, being quite crude, it will make dying in the UK more expensive for some individuals. It will make some people who have exposure to IHT and where IHT is a consideration quite an important thing. So, you know, if you're coming from Australia or New Zealand and you're coming to London and you're spending a few years here and then maybe moving on, perhaps not so much of an issue. If you're here with significant assets and you're shielding overseas assets, then that's where you're going to be much more concerned with this particular topic. There's also some worrying signs that certain connection factors could mean that in certain cases, IHT on worldwide assets could apply even where you're non-resident for more than 10 years. So that again is quite a warning sign on where this could go. IHT and trusts are actually very, very connected, and the current proposal is that the treatment of trusts will now change. UK trusts are subject to IHT on settlement every 10 years and on exit from the trust. So the rules will now look set to be altered so that the treatment of the trusts will now follow the settlers IHT at those relevant IHT trigger points. So again, it's a complex subject, IHT, subject to a consultation, but it is important that people are aware of those proposed changes and keep an eye on that. We're just going to bring here some tax traps. We've had quite a lot of interest on property, superannuation funds and everything else. One particular tax trap that's been identified is for Australians with rental property. If you've got a rental property business in Australia, the Australian tax year is different to the UK tax year, obviously, and also in Australia, certain deductions are allowable which aren't allowable in the UK. So, you know, you can have geared properties in Australia, lots of borrowing on those properties. The mortgage interest is allowable, and also depreciation is allowable in Australia. It's not in the UK. Because of the mortgage interest deduction differences, it could mean that somebody starts to become subject to UK tax on Australian income. You know, so if you've got Australian rental income, which you could previously shelter through the remittance basis and keeping that money offshore, under this new regime, 4 years into a UK residency, you'll be taxable on worldwide income. That Australian income will come into the UK tax net. And one of the questions that we received in advance was asking whether double tax treaties will allow that UK taxes paid on Australian income, will they be allowable in Australia? And the answer to that in this case is no, because the reality is that it's Australian source income, the Australian rental property, so it will always be taxable in Australia. That's primary taxing because it's in Australia. Unfortunately, you may not have paid any tax in Australia because you've got deductions which you can't claim here. When you do a UK tax return without those same deductions, you could end up with a liability. So it's just additional tax, and unfortunately no way to relieve it. So there are some tax traps there to consider. One identified one is with property income. Also, just go back to what we were talking about before, which is some of the opportunities and the temporary repatriation facility. So again, taking an example of how that could work, imagine Sam is UK resident and came from Australia, Australian domiciled, been resident in the UK for the last 20 years, so they're now UK deemed domicile. Sam's previously claimed a remittance basis historically and has what we call an offshore mixed fund with £1 million of untaxed foreign income in it. So Sam is in a situation where she's only taxable on income that she brings to the UK, and she's got this offshore fund, and we call it a mixed fund because in that fund there is potentially capital, various sources of income. And the way a mixed fund works is if you bring any part of the mixed fund back to the UK, you'll always bring what I always call the dirtiest part, or the one that will broadly give you the highest UK tax liability back. So Sam doesn't want to bring that back because it could be as simple as she's got an Australian bank account, Australian interest has been added while she's been claiming the remittance basis. She brings it forward, all the interest comes to the UK. So in 24-25, before these new rules come in, if she remits this mixed fund, this £1 million she gets back from Australia, brings it to the UK, a tax liability of £450,000 would arise, the £1 million at 45%. But if instead Sam waits and takes advantage of this temporary repatriation facility and the 12% tax rate that we talked about before, remitting it in 25-26, Sam is only subject to a tax rate of 12%. So the tax in that case falls from £450,000 to £120,000. So perhaps somebody who is minded to stay in the UK as a non-dom, and they think, well, actually, I'm going to make a go, I'm staying here, then perhaps this temporary repatriation facility will be an opportunity for them to bring some money over to the UK with a much lower tax rate. It's important to note as well, there may be foreign tax credits on this income, which may mean there's actually, in that particular case, no actual tax to pay. I think Naomi is now just going to talk us through some tax traps and opportunities.
Yeah, there's a lot of different tax traps and opportunities, and I'm just conscious that we're running a little bit short of time. We've sort of covered some of them. Some of them are up there on the slide. The big one that we haven't really talked about a lot yet is UK pension schemes. Some things to watch out for is those 25% UK tax-free lump sums are not tax-free when you draw them in Australia. So we often do, if we know people aren't migrating to Australia, then we look to try and get those drawn out of the pension schemes beforehand. There are options, some of them quite complicated, for exporting UK pension schemes to Australia by something called QROPS, which we haven't got up there on the slide. Be very careful if you're moving from Australia to the UK and you've got superannuation, because the UK do tax those withdrawals when Australia in most cases won't. So that's just a nasty sort of thing that needs thinking through in detail on a case-by-case basis before people migrate from Australia to the UK. If you are already living in the UK and you've got Australian superannuation, we can also help out with that and explain when foreign service relief is available, which is something that helps with relieving some of the UK tax on lump sum withdrawals from super funds. Some of the opportunities, the big one, of course, actually isn't up there, but inheritance tax. There is no inheritance tax in Australia. So if you are thinking about leaving the UK as a result of the changes to proposed changes to the inheritance tax regime, it is something worthwhile to entertain. I do often say to clients, seriously think about dying in Australia if you're from Australia, even though you might love the UK. And yeah, sometimes it's a bit of a morbid subject, but it is a lot cheaper to revive your Australian domicile of origin and pass away in Australia. And then I jokingly say to them that they may also get to see a doctor and they might live a little bit longer. So there's some pluses there with our overburdened NHS in the UK. So anyway, just a few things to think about in terms of trying to plan things out. Australia does allow negative gearing and 100% mortgage interest deductions, which is good if you've got rental properties. So there's pluses and minuses to both jurisdictions, but Australia is definitely the one to spend your latter retirement in and pass away in from a tax perspective. But that doesn't necessarily mean it's right for you. So anyway, feel free to reach out to us after this call, and if you'd like to discuss your personal circumstances. Back over to you, Andy.
Thanks, Naomi. We'll just quickly close off because, as you say, we want to get to the questions. So just a little, again, not too cheery, but you know, some of the Labour, but this is all politics. You know, some of the Labour comments on these changes haven't been exactly the most friendly. They're talking about how they would cut into the regime and make it even tougher. But having said that, you know, a lot changes in politics quite quickly. You know, and I think my last bullet point there, I would say, is that, you know, any government in any country is not going to want to see an exodus of talent or capital either. So, you know, just because this comes out as it is doesn't mean that it will be exactly as shown or be as fearful. But certainly, I think the message is very clear. There is going to be some fundamental changes here, and it's also something that for certain impacted people, they need to keep in contact with their advisors and just stay on top of it, really. So that's pretty much that's pretty much the presentation. So I think now maybe, Richard, if we're ready for questions.
Yeah, thanks, Andy, and thanks, Naomi. Firstly, just for everyone's benefit, this presentation's been recorded, and so yes, copies of slides and the recording will be available to all those that have registered. So no problems there. You know, just before I start, I note with interest in the paper this morning, the Times, they recorded that the government had a record haul of inheritance tax this year of 7.5 billion, up from 400 million in 2022 to 23. So they enjoy the benefits of the inheritance tax. That one is an absolute worry. Anyway, let's get to the questions. Firstly, a question from John. Thanks, Andy and Naomi. Is it correct that the UK will not recognise Australian franking credits, negative gearing, i.e. income only and no expense offsets, and concessional tax rates and super funds? Therefore, higher rates of UK tax will apply.
Yeah, so it's probably easier for me to take this question. Thanks, Richard. But the UK, when you're completing your UK tax return, no, you can't claim for your franking credits. You can't. There is no negative gearing in the UK, so you can't offset a rental loss against your other UK income. You can still do with that on your Australian tax return, even if you don't live in Australia, if you've maybe fortunate to have other sources of income in Australia. But no, you can't do that in the UK. And concessionals, superannuation basically just gets taxed if you've got an ongoing pension from your Australian superannuation fund, that just gets taxed as pension income in the UK. There are some special rules for lump sum withdrawals that I alluded to earlier. And that's probably the more tax efficient way to get that super out if you're not moving back to Australia.
Okay, yeah, so there's a few questions definitely around the superannuation area. It sounds like can I just read another one? And again, you may have answered this, but just to reinforce some comments. This one, firstly, will there be implications for people holding Australian superannuation but not planning to draw upon this until they return to Australia? So I guess that's, you've got to work out, let's say that the 4 years has been triggered, but not the 10 years.
Yes.
But you're not drawing on that superannuation in any shape or form, but I presume you're earning some sort of income from the investment from the superannuation. Does that fall into the UK tax?
My view is that, well, it certainly doesn't at the moment. Obviously, we don't have all the details of the legislation, but my view is that what the current Conservative government are proposing won't disturb that. But I think there is proposals amongst some of the Labor non-domiciled proposals wanted to attack what they call an excluded property trust. And that might be the legislation that in many cases Australians are relying on that legislation to not pay tax on the income accruing within their superannuation fund. So yeah, it's fine at the moment. It'll probably be fine once the Conservative government changes go through, but we don't know with certainty. Under a Labor government, I suspect that might become an issue.
Okay, let me ask another one. Again, this one relating to the capital gains tax for a primary residence. Will the new rules impact a family home that's in Australia that's been rented out with a plan to move back to Australia? What are the implications of the capital gains tax raised by the new tax rules?
Well, so depending on how long you've been in the UK, let's say you've been here for more than 4 tax years, then you might not be eligible to claim the remittance basis of taxation anymore. and that means that the rental income from your Australian rental property is going to be taxable on your UK tax return. I don't think that's not disastrous. You just need to make sure that you register for UK self-assessment tax returns if you haven't already. And then you need to report that UK rental income onto your, the Australian rental income onto your UK tax return. You'll be able to claim a credit for the Australian tax you've paid. So if this is a positively geared property, then you'll be paying tax at 32.5% in Australia from the first dollar. So chances are, if you're a 40% taxpayer, there's not too much extra tax to pay in the UK as a result of receiving that rental income. So, but it can be worse if there's a lot of mortgage interest, because you don't get a full deduction for your mortgage interest in the UK, whereas you do in Australia. So it's perhaps not the end of the world in terms of, you're probably in the round still better off hanging on to the property until you move back to Australia, because Australia's not going to give you any main residence exemption on selling the property.
Right, right. And Andy and Naomi, I might get you to look at some of the questions that were posted in advance to see if there's anything there that you feel that that hasn't been covered from the presentation. I think there's a number of questions here, including in the Q&A that's been submitted, where you have covered them to a degree. Is there anything there that you feel?
I think there was one question, Richard, where somebody's asked IHT implications if an Australian obtains British citizenship and then moves back to Australia. Could UK IHT be payable? And the answer to that simple question is yes. Once you're within the UK IHT net, you've got that 10 years potentially falling. But I think I would just be careful as well that when you're talking about British citizenship, this is all based on residence, so there can sometimes be a bit of confusion between Australian British citizens. You can be dual resident, but certainly from the UK tax perspective, the emphasis on this will be based on residency, not citizenship. But they could certainly, even if just because they move back to Australia doesn't mean that that's it and they're outside of the UK IHT net. So one to watch. Yeah.
And another question, Andy, if you just I've question from Daniel. I've read references to a £30,000 charge to use the remittance basis. Could you explain what that's referring to and who it applies to?
Yeah, under the current rules, if you choose to use the remittance basis, you automatically, so i.e. you don't want to be taxed on your foreign income that you keep offshore, you automatically lose your personal allowance and your annual CGT exemption. For what it's worth, it's only worth £3,000 now, so it's not the end of the world. Under these new rules for the 4 years, I think the proposal is that you'll continue to lose those benefits. But a lot of individuals, particularly if they're working in London, may not have a personal allowance because of the way that's abated when you become a higher earner. So perhaps not so much of an issue. But after a period of time, 4 years, you start to have to pay a kind of charge to use the remittance basis, and that increases over time. So that's really what that's talking about. That regime will disappear. That remittance basis charge will disappear under these new rules. So that's more about the current rules and regime that applies the cost of using the remittance basis.
And Andy, what is that period of time currently? It's something like 7 years, isn't it? You just pay like a fee of £30,000, and that covers the use of
it's
remittances.
4 or 7. Yeah, I'm testing myself there. It's 4 or 7. Yeah, and then you start to have to pay the remittance basis charge.
Right. Are there any other questions that people want to submit? Otherwise, I'm happy for Andy and Naomi to look at some of the questions that were submitted in advance too, and just check that there's anything else that hasn't been covered.
Shall I just cover a couple of the ones that were submitted already while we're waiting?
Sure, Naomi. Sure, Naomi.
So someone had asked about if they transfer savings from an Australian savings account to a UK bank account or ISA, are there tax penalties? So that really depends on whether you were using the remittance basis of taxation when that income or capital gains might have arisen that funded those amounts. But if that's relating to earnings or capital gains or an inheritance or some other windfall that arose before you became UK tax resident, then no, there's no tax penalty on that. So you just have to watch out for those remittance basis rules, which Andy explains that there is this opportunity for non-domiciled persons to pay a 12% tax rate on remitting some of those. So I'm sure well, either he or myself can help you out with that. Someone did ask a question about New Zealand trusts. Obviously, this talk is about Australia and the UK. If you do happen to have a New Zealand trust and you've moved to the UK, you definitely need to get some tax advice. There's some very complicated tax rules in New Zealand, which you need to make sure that your trust is still complying under the New Zealand's tax system to avoid penalties there. And you also need to get some UK tax advice to make sure that your New Zealand trust is complying with the UK tax rules, particularly if it has become a UK tax resident trust. So there's just a couple of things. Someone had also asked about property that had been inherited in Sydney from their parents, and they're concerned about facing large capital gains tax. It's just important to get this, if this has been the main residence, it's important that we get the sale done in the right way so that we can try and still claim the Australian main residence exemption on that if you're as the beneficiary living in the UK. So we might be able to help with that, with trying to make sure that we've got an Australian tax resident estate selling up the property to try and make sure the main residence exemption is still available, but it does need to be sold within 2 years of the death to get the full rate there. So
yeah, it's good. Thanks, Naomi. Andy, look, we might wrap things up now at 10:59. Look, you know, obviously your details can be provided and they should be on. We can facilitate if people need to contact you directly with follow-up questions. But I think I just want to sort of echo a couple of comments that you made, Andy, up front. And I have limited knowledge, so this isn't special advice, but it seems to me that, you know, watch carefully what's going on with regard to these proposed changes. Next election and then the next spring budget will be the trigger point, obviously, as to when the new government will probably announce and bring into play certain tax changes. But it sounds like the 4-year mark and the 10-year mark are key periods of time for individuals to be thinking about, whether you then become, if you like, domicile after that 4-year period, or when you hit the 10-year mark, the inheritance tax kicks in. Those two time periods seem to be quite key, Andy, for mine. So to watch that. And look, I guess the answer, or the comment I'd like to make again is just be prepared. You know, I think Andy made some really good comments. Talk to your tax advisors, talk to your accountants, do some sums on the back of a packet of facts, as Andy said. But this is worthy of preparation. I know of some people already who are already planning on getting out of the UK, exactly what the UK probably hasn't calculated in their activities. And as someone said, this is somewhat political as much as it is economic. But I just sort of, our advice is on the back of Andy's and Naomi's advice is do your homework and be prepared. Thank you everyone again for your involvement and participation. Again, we will share and send out a link to the video itself. And my thanks to Andy and Naomi for your expert advice.
Thank you.
Thanks, guys.